Look around the crypto space right now, and you'll feel it. A strange, heavy quiet. A pervasive stillness that is far more telling than any dramatic price crash. The frantic, meme-fueled energy of a bull market is gone. The explosive rallies and catastrophic liquidations have faded into a flat, monotonous hum. And this unsettling calm is the most critical signal you're not being told to watch. If you're feeling that eerie uncertainty about where the market is headed next, if you're wondering whether this is the bottom or just the calm before another devastating storm, then you are not alone. And you need to understand exactly what this deafening silence is screaming at us. This isn't just a lull. It's a profound market diagnosis. A story told not in volatile price swings, but in the cold, hard, unemotional data of the derivatives market that most retail investors completely ignore. So, do me a huge favor, hit that subscribe button and ring the notification bell right now, because what I'm about to break down for you is the real, unfiltered truth about the crypto market's vital signs. This analysis will fundamentally change how you interpret these quiet periods, transforming you from a passive observer, vulnerable to the next big wave of volatility, into an informed strategist who can see the tides shifting before they even arrive. The core of this entire story lies in a single, powerful metric that has effectively flatlined Bitcoin futures open interest. After the significant and painful deleveraging event we all witnessed back in October, that brutal, market-wide flush that vaporized over-leveraged longs and shorts alike, wiping billions of dollars in leveraged positions from the board in a matter of days, the open interest has simply not recovered. It has remained subdued, lethargic, and historically low, showing absolutely no indication of new speculative positions building up in any meaningful or sustained way. Think of open interest as the market's collective heartbeat, the electrical pulse that runs through the entire trading ecosystem. It represents the total number of outstanding derivative contracts, like futures and options, that haven't been settled or closed out. When open interest is high and rising, it's like the market is taking a deep, greedy breath, filling its lungs with leverage. It means a flood of new money, new bets, and new convictions are pouring into the system, creating a dense, interconnected web of speculative interest that fuels both dramatic rallies and equally dramatic crashes. This high open interest environment is what we experienced for much of the last cycle, a period defined by excessive greed and the intoxicating belief that prices could only go up, fueled by cheap leverage and boundless optimism. But now that pulse is weak. The data, meticulously reported by analytics firms like Glassnode and highlighted by Foresight News, paints a clear and unambiguous picture. The activity in the Bitcoin derivatives market has plummeted to a whisper. The great deleveraging of October didn't just reset the board, it traumatized it. The speculative froth has been completely scraped away, leaving behind a market that is cautious, weary, and fundamentally uninterested in making big, leveraged bets. This isn't just a minor downturn in activity. This is a sea change in market participant psychology. The traders, the institutions, the hedge funds, they haven't simply stepped back to the sidelines. They've looked at the current macroeconomic landscape. With its persistent inflation, rising interest rates, and global geopolitical instability, and they've collectively decided that the risk of deploying massive leverage into Bitcoin simply isn't worth the potential reward right now. This mass departure from the derivatives arena tells us one thing more clearly than any price chart ever could. Professional money is not convinced that a sustained V-shaped recovery is imminent. They are not betting on a sudden, dramatic explosion to new all-time highs. Instead, they are waiting, watching, and preserving their capital, and that behavioral shift is the very definition of an overall bearish market sentiment. This low open interest environment creates a self-reinforcing feedback loop. With fewer leveraged positions on the board, the fuel for violent cascading liquidations is significantly reduced. This is why we see these tight, range-bound price movements. There simply aren't enough large leveraged positions to trigger a domino effect of forced selling or frantic buying. The market becomes mechanically stable but emotionally dead, lacking the catalytic energy for a significant trend change. Understanding this dynamic is your key to navigating this complex phase. It means that until we see a sustained and organic resurgence in open interest, driven by genuine conviction rather than fleeting hype, the market is likely to remain in this state of fragile equilibrium, where every minor rally is sold into and every dip is met with apathy. This is the great unwinding, and recognizing it is your first step towards strategic clarity. So, if the pulse of the market is this weak, if the professional money has fled the derivatives arena and we're left in this vacuum of speculation, the billion-dollar question screaming for an answer is this: what happens next? Where do we possibly go from here, trapped in this mechanical stability that feels less like a foundation and more like quicksand? The truth is, this period of low open interest and subdued derivatives activity is not an ending. It is a critical and often misunderstood phase of the market cycle, a necessary cleansing that sets the stage for everything that follows, and your ability to interpret the subtle shifts within this quiet will determine whether you become the predator or the prey in the next major move. Let's be brutally honest. This is not a fun place to be for most traders. The adrenaline is gone, the constant noise has faded, and the opportunities for quick, leveraged profits have dried up almost completely, which is precisely why so many inexperienced players will grow impatient, make emotional decisions, and exit the market entirely, crystallizing their losses right before the landscape changes. But for the strategic, patient investor, this is the most fertile ground for future growth, because these periods of low speculative interest are where the market's foundation is silently, methodically rebuilt, brick by brick. Think of the October deleveraging as a forest fire. It was devastating and destructive, incinerating the weak, overgrown underbrush of excessive leverage. The landscape it left behind appears barren and lifeless, a charred reminder of the past frenzy. But beneath that surface, the soil is now richer than ever, cleared of the parasitic speculation that choked out real organic growth. And it is in this very soil that the seeds of the next bull market are slowly, invisibly beginning to germinate. The key is to shift your focus entirely away from the dormant derivatives market and toward the on-chain data, the fundamental metrics that tell the story of what the long-term holders are doing while the speculators are asleep. While open interest remains low, we are witnessing a massive historic migration of Bitcoin away from exchange wallets and into long-term cold storage. This is not the behavior of a defeated market. This is the behavior of a market that is maturing, where conviction is outweighing convenience. The coins are moving from the hands of the weak, who need immediate liquidity and leverage, into the diamond hands of the strong, who view this not as a trading vehicle, but as a fundamental store of value. And they are using this period of price suppression and fear to accumulate at levels they may never see again. This is the great accumulation, the silent bull market that plays out on the blockchain, completely unseen on the price charts. Furthermore, the lack of new speculative leverage means that the market structure is becoming incredibly healthy, almost by force. The weak hands have been washed out, the systemic risk from over-leverage has been drastically reduced, and the remaining Bitcoin is held by people who are unwilling to sell at these prices. This creates a phenomenally solid base, a launch pad with very little selling pressure overhead. When the eventual catalyst arrives, whether it's a shift in macroeconomic policy, a regulatory clarity milestone, or simply the natural progression of the 4-year halving cycle, the market will have very little friction on the way up. There will be no massive wall of leveraged long positions to liquidate and stifle the rally's momentum. The first move upward will be driven by pure organic spot buying, and in a market with low supply, that can lead to a violent and rapid repricing that catches the entire world off guard. The speculators and their leverage will return, of course, but they will be followers, not leaders. They will be forced to chase the price, pouring gasoline on a fire that was already burning brightly on its own. Your mission during this time is not to predict the exact day the music starts again, but to ensure you have a chair waiting for you when it does. This is the time for disciplined dollar-cost averaging, for deepening your fundamental research on the projects you believe in, and for building a rock-solid portfolio that isn't dependent on the wild swings of leverage. The silence is not your enemy. It is your opportunity to build, to learn, and to position yourself strategically while everyone else is distracted by the lack of noise. The next cycle will not be won by the fastest trader, but by the most patient investor. So, if this deep dive into the real mechanics of the market has given you a new perspective, if you're ready to start looking beyond the price chart and into the on-chain data and derivatives metrics that truly move the needle, then I need you to do one more thing for me. In the comments below, tell me one key takeaway you're bringing away from this analysis, and let me know what specific metric, whether it's exchange net flow, minor reserves, or something else entirely, you want me to break down in the very next video. Your journey to becoming a more informed, strategic investor starts now, and I'll be right here with you, breaking down the complex into the clear every step of the way.